Hello. This is a review of the practice problems for the week utilizing Excel. So the first practice problem is asking you to calculate accounting profit and economic profit. The problem states that there's an individual who runs a small pottery firm. He hires one helper at $10,000 per year, pays annual rent of $4,000 for his shop, spends $16,000 a year on materials. He has $40,000 of his own funds invested in equipment, pottery wheels, kilns, and so forth. That could earn him $4,000 per year if alternately invested. He has also been offered $18,000 per year to work as a potter for a competitor, and he estimates his entrepreneurial talents are worth $2,000 per year. Total annual revenue from pottery sales is $65,000. Okay, so when we start, let's start by writing down all these costs, okay? So he has one helper at $10,000 per year. Next one, he has annual rent of $4,000 per year. After that, materials, he says he spends $16,000 per year. And so he has his own investment into the company. So his capital is worth $40,000. And alternate investment, it could earn him $4,000 per year if he alternately invested that $40,000. He also has an alternate job, which could get him $18,000 per year. And he estimates his entrepreneurial talent to be worth $2,000 per year. His total revenue is $65,000. So the first thing we've got to look at here is what we consider to be our accounting profit. So how do we calculate our accounting profit? Well, accounting profit is simply the revenue generated minus explicit costs. So it's the revenue minus explicit costs. So what then are explicit costs? Right? So it's those costs that are directly incurred by the activity. So the helper is an explicit cost. The annual rent, right? That's an explicit cost as well, as are the materials. They are the explicit costs of the production process. So we can say our accounting profit is going to be equal to our revenue minus our explicit costs, which are the $10,000, the $4,000, and the $16,000. It gives us an accounting profit of $35,000. Now, what's our economic profit? Well, this is simply equal to our revenue, right, minus our explicit costs, minus our implicit costs. In this case, right, our alternate investment, right, our foregone interest is an implicit cost. Our foregone salary is an implicit cost. And our wasted entrepreneurial talent is an implicit cost as well. So, simply put, the revenue minus our explicit cost, which is our accounting profit, is simply this $35,000. And now we're going to take out our implicit costs. Our economic profit is $11,000. The next question is looking at average fixed costs and marginal costs. You are a newspaper publisher you're in the middle of a 1-year rental contract for your facility that requires you to pay $600,000 per month, and you have contractual labor obligations of $1,250,000 per month that you can't get out of. You also have a marginal printing cost of 25 cents per paper, as well as a marginal delivery cost of 10 cents per paper. So the first question is asking, if sales fall by 20% from 1 million papers per month to 800,000 papers per month, what happens to the average fixed cost? Well, let's take a look at what numbers they've given us so far. So we have a 1-year rental contract for the factory, right, that requires you to pay $600,000 per month. So we have rent of $600,000 per month. We also have labor, which costs us $1.25 million per month as well. So $1,250,000. There we go. Okay, and then we have marginal printing costs as well. So then we have marginal printing costs, and we have also marginal delivery costs. Right. Our marginal printing cost is 0.25 cents per paper, and our delivery cost is 0.10 cents per paper. Just add this dollar sign here. So the first question is asking us to look at average fixed cost. Okay, so our average fixed cost, if we're looking at our costs here, right? Our rent here, this is considered to be a fixed cost. Our labor is also a fixed cost, whereas our printing cost is variable and our delivery costs are variable as well. So what's our average fixed cost if we sell 1 million papers? Well, our average fixed cost is simply the total fixed cost divided by the quantity. So our average fixed cost at 1 million papers sold is simply going to be equal to our total fixed cost, right, divided by our quantity. In this case, it's going to be equal to our total fixed cost of 600,000 plus our 1.25 million divided by our quantity of, in this case, it's 1 million, $1.85. So that's at 1 million. Now we say the same thing here, right? Our average fixed cost at, instead of doing 1 million papers, we're going to do 800,000 papers. Again, it's simply our total fixed cost divided by our quantity. In this case, it's equal to our 600,000 plus our 1.25 million divided by, in this case, is 800,000. So our average fixed cost rises from $1.85 to $2.31 per paper. What happens to the marginal cost? Well, the variable costs don't change regardless of how many we deliver or sell, right? It's still going to be 25 cents per paper and 10 cents per paper. The next question is asking you is, what happens to the minimum amount that you must charge to break even at these costs? Well, if we're looking at 800,000 papers, okay, so remember, what is our equation for total costs, right? Total costs is simply equal to our total fixed costs plus our total variable costs. Well, what will our total fixed costs be? Well, this is simply going to be equal to our total fixed costs will be the 600,000 plus the 1.25 million. Right? Our total variable costs will be the 25 cents per paper times our 800,000. So our total costs, really we should say at 800,000 units sold. So what we're going to do is we're going to say it's going to be equal to total fixed costs, right? So it's 1,850,000 plus our total variable costs. It's going to be the 0.25 times 800,000 plus the 0.10 times 800,000. So we actually run this out. And we're add in our total variable costs, which is this, times 800 plus this times 800 we have total costs of 2.13 million. Now, if we're trying to figure out how much of this do we need to charge per unit, right, our per unit cost, right, we calculate our per unit cost, we simply have to take our total costs divided by our quantity sold. So our 2.13 million divided by 800,000 gives us $2.66 per paper. And this is what we need to break even. Now you can do the same thing at the million, right, to determine what your fixed cost, what your break-even point was previously, right? So your previous break-even point our previous break-even point. Alright, so then here we'll do our million before at 1 million. Alright, so instead of here it's 1.5 million, it's 0.25 times 1 million and 0.10 times 1 million. Right? So then we can actually say it's equal to our 1.85 180 plus 0.25 times 1 million plus 0.10 times 1 million. And then dividing up by the quantity, making sure we change this as well. And so we say we had a previous per unit cost of $2.20. Because sales dropped, our new per unit cost has increased to $2.66. The reason being, our fixed costs are much greater than our variable cost per paper. For the last question, we're looking at economies of scale. The question states, suppose a firm is producing in the long run. When it produces 2,000 units of output, the total cost is $6,000. When it produces 2,200 units of output, its total cost is $6,200. And when it produces 2,400 units of output, its total cost is $7,000. So let's take a look at this information here. So we have some information. We have some quantity. We have some total cost. And with this first information, we can take in the information we're given. At 2,000 units, our total cost is $6,000. At 2,200 units, our total cost is $6,200. And at 2,400 units, our total cost is $7,000. So one thing we want to look at here then is the average cost, or the per unit cost. So the average cost. Right, we calculate average cost by simply taking our $6,000 divided by our quantity. Average cost of $3. If we fill this down, and we increase the decimal places there, and now we can see the average cost is changing. So between the 0 and the 2.82, right, we can say that the firm is increasing or experiencing increasing economies of scale. So we have decreasing costs. But then from 282 to 292, it went up, right? We had increasing costs. So now the firm is experiencing decreasing economies of scale. So look at this again, right? If we had some other information here. So let's say we're going to do this again in another manner. Okay, so let's look at another problem of this. So we'll say a firm has quantity 2,000, total cost is equal to 4,000. Right, at 2,200 or at 2,300, the total cost is 4,100. And then at 2,600, the total cost is 4,200. Well, we can see here $2 to $1.78. We have increasing economies of scale because we have decreasing costs. And when $1.78 to $1.62, we again have increasing economies of scale because we have decreasing costs. Now, if we do it one more time here, some new numbers. We'll say again at 2,000 quantity, we have some total cost of 8,000. At 2,100 units, we have a total cost of 8,600. And when we have 2,200 units, we have a total cost of $9,200. Well, we can clearly see that went from $4 to $4.10 average cost. We have increasing costs, so we have decreasing economies of scale. Again, from 410 to 418, cost increased. Therefore, we have decreasing economies of scale. And then finally, for one last example, we'll say at 4,000 units, total cost is $8,000. And then at 4,100 units, total cost is $8,200. And then at 4,200 units, total cost is $8,400. Well, average cost didn't change, right? So we're experiencing a constant economies of scale. No change in cost. Well, really average cost. And so we can say that in this instance as well. Alright, so this is a review of the practice problems using Excel. I'll be posting this Excel sheet so you can work through these questions and use these sheets as an aid. If you have any questions, please feel free to post to the discussion board under general questions or to email me. Have a great week.